Don't fight the Fed. It's a mantra investors know all too well, but an exception has emerged. Gold investors are fighting the Fed and winning. The reason why tells us what could happen when interest rates finally fall. Don't fight the Fed is a saying that means exactly what it sounds like. If the Federal Reserve is in a tightening cycle and create a restrictive monetary policy, it should depress derivative investments like stocks and bonds. Stocks because expensive debt is bad for business, bonds because as rates go up, the value of bonds declines, and it can affect other assets too. Some parts of the country are in the beginning of housing market corrections as higher rates create unaffordable conditions for many. If you look at the S&P 500, you'll see investors largely got the memo. The Federal Reserve began raising rates in March 2022, and the S&P 500 declined for several months. It did not recover to its previous all-time high, set in 2021, until January of 2024, after Fed board member Christopher Waller made comments hinting at future rate cuts. Gold has not reciprocated the action of other markets or paid even a token acknowledgement of its own past behavior. It has, without apology, continued to rise amidst high interest rates, breaking records repeatedly. This is unusual for a few reasons. Normally, gold is thought of as a safe haven asset. Investors will flock to gold when they believe other assets will not perform and they need a safety net to store their wealth. Treasuries are often favored as an alternative to gold when rates are high, and treasuries have been very high compared to their historical performance in recent years. The yield on the one-year treasury has been over 5% for most of the last year, and many new notes were issued after the budget was approved and the treasury coffers needed to be refilled. In this environment, spot gold prices should be taking an ugly beating. Instead, gold rose to $24.50 per troy ounce before taking a modest pullback of about 4%. So what is going on? Well, gold rose to $2,450 due to a confluence of events, but it cannot be denied that expected rate cuts were an initial catalyst for a forward-looking market. However, if that were the only variable, then gold should have plunged on news from the Fed in June when they officially dashed investor hopes for substantial rate cuts this year. Remember, we went from pundits confidently telling their viewers that 6 rate cuts were in the cards for 2024, and now we are looking at most likely 1. In a rational market, if that were the only variable, gold prices should have plummeted. So we can look to a few other factors driving gold prices. And there are the usual suspects, of course: war, politics, and inflation, to name a few. But this story isn't complete without China. The PBOC, or People's Bank of China, is the central bank responsible for monetary policy in China. While they recently paused their gold buying spree in both May and June, China did buy massive amounts of gold for 18 months straight. This protracted surge of gold buying has helped buoy the price of gold. Political analysts believe that China's gold buying spree began in earnest after the US froze Russian assets with sanctions in response to the Ukrainian invasion. China has been pushing for de-dollarization ever since, and they are leading by example. As China has divested itself of US treasuries, they have instead bought gold, which may reduce their interest income but ultimately provides resilience and security against potential sanctions. Analysts have suggested that China's record gold buying is one of the main reasons for gold's detachment from other long-standing economic factors. Well-known publications like Bloomberg, Business Insider, The New York Times, and more have reported on the phenomenon, with some saying the West has lost control and China is the main determiner of gold prices now. While China did pause its gold buying, we have yet to see any evidence that China is done amassing gold as part of its long-term strategy. In 2023 alone, the PBOC bought 735 tons of gold, and the private sector imported over 1,400 tons of gold. The United States still holds the most gold in the world at 8,133 metric tons, valued at over $560 billion by today's spot price. However, China's aggressive pacing is setting the price. Simply holding gold does not directly affect spot. The trading action does, as prices are determined by supply and demand. If gold is taken out of circulation and stored away to preserve wealth, it does lower the total supply in circulation. But if it remains untouched long enough, the market adjusts and goes on. And the new mining supply is ever present, and the market will seek out an equilibrium price. Eventually, whatever was stored away over time is essentially taken out of the equation unless the owner goes to sell. Although high interest rates should be dampening gold prices, it's possible investors are aware of the impact that falling rates will have and that the PBOC is having, and are making their bets now. With markets being forward-looking and some forecasters predicting gold's ascent to $3,000 per troy ounce by 2026, it's not hard to see why many would invest in gold now with an expected payoff of 25% within 2 years. But there is certainly risk in betting on new all-time highs. If gold retreats, then it could be some time before investors are able to recoup their investments. In the wake of the 2008 global financial crisis, gold soared to all-time highs. In 2005, investors could buy gold for $500 per ounce. By 2011, gold was regularly trading over $1,600 an ounce and even broached $1,800 an ounce for a brief period. Investors who bought in this time frame would have had to hold their investments until 2020, when gold again leapt to new all-time highs to recoup that investment. Now, in a sense, the investment was very safe. There was no chance it could go to zero, but some investors had to wait a lot longer than they probably expected to recover from such a protracted pullback. Now, others see the opportunity to invest in silver. With gold ascending to new all-time highs, savvy investors expect silver to follow suit. Silver's prior all-time high was nearly $50, and at today's spot prices, it has room to grow over 60% before reaching its prior all-time high. Now, this makes silver a comparatively safer bet for many people, and it's entirely possible that silver creates a new all-time high of its own in these historic times. As silver, like gold, should be taking a nosedive from interest rates, and yet silver remains resilient in the face of long odds, having recently achieved a 10-year high in the spot price. As we prepare this video, silver has again broached the $30 an ounce mark in a nod to the silver bulls who have always believed in its potential. Regardless of your current stance on interest rates, China, gold, or silver, it's undeniable the impact that interest rates should be having on gold, and it's undeniable they are not holding gold down. But while we think China is a driving force behind gold's price action, it's true there are many other factors that impact gold. So, what do you think? Are Chinese buyers the main variable to watch? Or are there other elements to consider in these strange times? Now, we have noticed that with 2 months of abstention from the PBOC in the gold market, spot prices remain elevated near their all-time highs, which may imply there are other factors to consider. Leave your thoughts in the comments below. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.